All right, welcome back. Ryan Miller Trading Economics. Today we're going to talk about gold and gold's likely reaction to the upcoming recession. All right, so let's get right into it. I'm going to try to make this short and sweet. So gold, for those of you who don't know, has a very strong relationship with real rates, with real interest rates. Okay, what a real interest rate is simply if you were to take a U.S. Treasury yield, the nominal yield, it's subtracted from inflation expectations. So a lot of people make the mistake of taking let's say the 10-year nominal yield and subtracting it from the CPI. Okay, the CPI is backwards looking. We want to look at something that gives us a more forward outlook. So what we look at is the break-even rate, which measures inflation expectations. So if we were to take the 10-year yield subtracted from our break-even rate, 10-year break-even inflation rate, you get our real rate, our 10-year real rate, which sits at about 1.22. Okay, now gold has a very strong inverse relationship with real rates, and why that is because gold and treasuries are considered safe assets. All right, now when real rates are rising, that means nominal yields are rising relative to inflation expectations. And there's an opportunity cost to hold gold because gold doesn't pay any dividend or yield to investors. Okay. Now, when real rates are falling, nominal yields are falling relative to inflation expectations. Well, that opportunity cost diminishes. It makes gold more attractive, cheaper, right? So capital will flow into gold. So that's why, generally speaking, gold and real rates have a strong inverse relationship. And if we were to throw gold on the chart here, we can take a look at that inverse relationship. Real rates fall, gold rises. Real rates rise, gold falls. And if I were to invert gold here, flip it around, you can see that relationship a lot more clearly. Real rates over time or gold rather moves with real rates over time. Okay, so when we get into recession, a couple of things happen. First, when a recession happens, it's a deflationary shock to the system, right? Liquidity dries up, demand gets crushed, deflationary shock. And in the deflationary shock, gold falls because gold is one of those assets that investors sell in order to obtain dollars, right? Liquidity dries up, dollars are scarce. Investors sell gold to try to obtain dollars to service their debt, payments, margin calls, etc. Also, what happens during recession, real rates spike. When real rates move higher, gold falls. Now, why real rates spike is because during recession, obviously, capital is going to flow to safe assets, right, like U.S. Treasury. So we expect yields to start falling. What happens during recession is that inflation expectations fall faster than nominal yields do, and that causes real rates to spike. So let me uninvert gold here, and we can see that took place right here in 2020. Right, deflationary shock, real rates are in the white here, real rates spiked, gold fell. Okay, go back to the GFC, 2007, 2008, real rates spiked, gold fell. Okay, so I expect the same thing to happen once we get another deflationary shock to the system. Demand's already being reduced by monetary policy, right? Interest rates rising, right? Dollars, as we know, the dollar has been rising, right? Dollars are becoming scarce. And in that environment, gold gets sold to obtain dollars. So once things really hit the fan, we should expect inflation expectations to fall faster than nominal yields. Real rates are going to spike and gold's going to fall. At the same time, gold's going to be getting sold to obtain dollars. So it's going to have a lot of downward pressure on it. Okay. So we should expect that same thing to happen once we get into recession. Okay. Now, oops, sorry about that. So if we were to take a look at gold, now I expect this to play out over the next, say, 3 to 6 months. Now, during that time period, from this point over the next, say, 3 to 6 months, we could get in a situation where inflation expectations, now there's not really much to push inflation expectations higher at the moment, right? Commodity prices are falling, oil's falling. I think the market's starting to realize with growth slowing that recession is all but inevitable. So, but we could get in a situation where there could be a time period where yields start to roll over and inflation expectations don't really move too much or start falling at a slower rate than nominal yields, and then real rates start to fall. And in that environment, we'll see gold rally. So we could have that over the course of the next 3 to 6 months. But like I said, once things really get serious in the markets, we get the deflationary shock, investors are selling gold, real rates spike, I expect gold to fall lower. So it's been stuck trading sideways for quite some time now, really since 2020. And it hasn't been able to break this low. Right about 1665 or so. Right about there, or 1670 rather. Come close. We're flirting with breaking it. We flirted with breaking it a couple times or a few times already. Now we're looking like we're going to break out of here. And of course, we want to wait for that breakout, right? This weekly chart, we want to wait for a nice close below the weekly. So if you're a trader, what you're going to look for, it's a nice close out of here, pull back to supply like we always talk about, and then we go look for supply levels, look for some minor structures to get broken down, and then we're looking to trade it lower. Okay, now where could gold fall to? It sits around 1664, give or take. Once it breaks out of here, it's going to be some demand right in this area here, 1630. So that could provide some issues, right? This was the 2020. This was the March 2020 high, which has been tested multiple times already, right? So once we break out of here, we should move lower. Again, there's some demand here, which could give us problems. But this big move here from the lows of March started all the way here, started way down here at around 1450. Right, so I think once gold breaks out of here, maybe hopefully get a pullback if you're a trader. That's what you're looking for. Look to take this lower. I think we're going to get gold's going to fall into this 1500 to 1450 range. That's where I'm going to be looking to target. Right, now this high from back in 19 was taken out by this move down, but we should expect some strong demand given this impulsive move higher that started from way down here. So I expect price to come and retest this. Right, if you look on the monthly, it's a long wick. It's a long buy wick right there. A lot of buyers in there. I expect price to come down into this area and test here, that 1500 to 1450 area. Okay, now this, again, this move technically took out this high, right? So it took out buyers that were in this area here, just technically speaking right now. So we could trade lower. We could end up trading to these highs here, back from, what was this, 2016, right in this 1400, 1375 area. But once we break out, at first big targets that I'm looking for, like I said, 1500 to 1450 area. And if we go lower, that would be the next one, 1375. Could get down to this demand down around 1300 with the start of this push higher, right? This lower high was made that broke these highs. That sits around 1300. So those are levels that gold could potentially fall to, right? Depends on how bad the deflationary shock is. Okay, so once we get into, like I said, recession territory, gold's should start falling more as liquidity starts to dry up, and once inflation expectations start to really crash and they're going to fall faster than nominal yields, should get a spike in real rates, and that's going to push gold lower. So that's what we're looking for. And again, from a technical aspect, you're just looking for the break lower, pull back the supply, and then look to take it down. right? Just like we've gotten over in past videos. And that's really it. Just want to keep this very simple. What gold's likely going to do once we get this deflationary shock to the system. Remember, it has a strong inverse relationship with real rates. Real rates are going to spike. Gold's going to get sold by investors to obtain dollars. Gold's got a lot more downside to come over the next, say, 3 to 6 months or so. Okay. So that's what we're going to be looking for in that time frame. All right. If you have any questions, let me know. Make sure you like, subscribe, share if you enjoyed it, and I'll catch you in the next one.